Let me tell you a fun fact. Within the last 2 centuries, more than 90% of the world's millionaires have been created by investing in real estate. But if done incorrectly, without the right knowledge, required skills, or partners, it can also create a ton of problems and a lot of sleepless nights. You feel like sometimes there are way too many gurus out there trying to sell you on a weekend course, or just too much noise to cut right to the facts? Yup, we did too, and this is why we started this podcast. Our goal is to provide real estate investors, entrepreneurs, and enthusiasts with all of the most recent knowledge, secrets, tips, tricks, and tactics so that you can grow your own portfolios, increase your returns, net worth, and most importantly, create generational wealth for you and your loved ones. Remember, this is your real estate career. Information is your sword and shield, so eat hearty, prepare for battle, and grind your way to victory. My name is Tejas Gosai. I'm joined by my partner, Jeremy Moyer, and we welcome you to the Real Estate Investor MBA podcast.
Welcome back to Real Estate Investor MBA. My name is Jeremy Moyer. My co-host Tejas and I both like to start off all our episodes with a huge thank you to all our listeners. If you'd like us to review a specific topic or even cover a specific question that you may have, please send those to jeremy@realestateinvestormba.com. Also, please check out our new website, rei.mba. You can find all our previous episodes there. If you're interested in what we're working on or you want to follow us, you can sign up for a free newsletter right there on the website. Also, be sure to follow us on social media. We're all over different podcast platforms. We're on YouTube, we're on Facebook, LinkedIn, Instagram, etc. So now on for our guest that we had on today, Clay Hepler. Clay is a multifamily investor, educator, and cash flow specialist. He is the principal at a boutique investment real estate firm, Hepler Acquisitions. Hepler Acquisitions focuses on purchasing value-add real estate properties and increasing their worth through diligent construction management and adding visionary yet functional designs to provide housing for their residents. Clay has purchased over $6 million of multifamily real estate in the greater Pittsburgh area over the past 24 months using a combination of his own capital and private capital. Man, we just came out of this really great interview with Clay where Clay really broke it down. He talked about BRRRing your business. So specifically with multifamily properties is where he specializes in. And Clay has been able to go full-time in real estate in just 2 years. I think you guys are really going to enjoy this one. Welcome back to Real Estate Investor MBA. We're really excited for the guest that we have with us today, Clay Hepler. Clay, how you doing?
I'm doing great, man. Talking to you from Colorado, Rocky Mountains. So beautiful up here right after this. I'm going to go for a great hike. So things are going well.
Yeah, that's awesome, man. So for folks who aren't, familiar with you, I've seen you online or listen to your own podcast, right? Can you spend a few minutes telling us a little bit more about yourself and how you ended up, getting started in real estate investing?
Yeah. So my story is pretty quick because I haven't been in the business for some of the guys like Ken McElroy been in the business for like 40 years. So my goal in life was to be a diplomat, Jeremy. I wanted to work for the State Department. And so I based my college decision, my life decision. I was like, I'm going to do this. I'm going to climb this ladder. And I had visualized that I wanted to do that. Ended up working for the State Department, the embassy in Buenos Aires, and hated it. I really didn't like it. It wasn't very meritocratic. It was very hierarchical in terms of like you put in X amount of time and there was very little input to output, right? So it's not really your efforts. It's not your merit. It's just, hey, you've been in the business or the State Department for 5 years. Now, instead of stamping passports, you can do X, Y, and Z. I think it's a tremendous career path for some people. Just didn't work for me. After that, I decided, hey, I want to take some time off of college, some time off figuring out what my job is. I joined a family chocolate company and scaled that business from 2 to 42 states in 18 months. We did guerrilla marketing, cold calling, direct to business ads like Google ads, and built relationships with large hotel chains like the Omni Hotel chain, celebrity chefs, those in your older crowd, if you have any older people for QVC, and really had a lot of success with that. And during that time, I met a guy that was incredibly successful developer in a major metro area. He was a real estate investor, developer, and a bunch of other businesses. And he told me that, hey, Clay, in order to get wealthy, and I was very young at this point, you need to own equity. you need to find a way to capture equity, because equity allows you to build wealth. It allows you to build wealth by not paying for taxes, by finding value in certain things, whether it's a business, a different asset, real estate. And he really taught me, he taught me, hey, you should start to read a couple of books about personal finance. He talked a lot about real estate because that was his primary background. And I learned from him, hey, I got to get into real estate. So I actually dropped out of the family business, joined a local company where I currently am doing the majority of my investing, which is Pittsburgh in Western Pennsylvania. And I joined this company and I had a lot of sales experience. So what I did is I went right into a role underwriting multifamily deals, self-storage deals. And then I built a wholesaling division within that company. We did 75 deals in our first year. And then that's through just, hey, implementing the same tactics, marketing, sales, negotiation systems in the wholesaling business. All along the way, about 2 years ago, I bought a house hack. Everyone probably knows about house hack. You live in one apartment or you live in one room or whatever, and you use the rent that the property is using to pay for your mortgage. So you basically live for free, or you have to pay a little bit, so you minimize that expense. Well, I did that and had a tremendous amount of success. And I scaled to 36 units using the BRRRR method in a little under 2 years, just using my own capital, using private lenders. And I quit my job and I'm financially free. So I flip a little bit. I buy multifamily deals, and I had 14 units in May and I basically doubled in 3 months. So I'm going to continue to double and double and double, and using the tactics that I'm sure we're going to talk about here today. I know there's a lot, but I just wanted to give you that short story arc, where we are now.
No, that's tremendous. I love that. We all start off thinking we know what we're going to do, right? And then, as you start doing that, you're like, yeah, I don't like that. I like this, and you find your path, but you learn along the way. And it seems like you've learned and you found mentors along the way, which is very impactful. No, I love your background. That's great. So yeah, let's kind of dive into, that's really great scaling, especially not having to take a lot of outside capital, right? And you mentioned the BRRRR method. So I'm sure a lot of our listeners know what the BRRRR method is, but for those that don't, can you kind of just outline that? And then also right after that, kind of take it to where's that sweet spot? We were talking offline right before our call today that a lot of investors I know use it maybe on single families or maybe duplexes, but you think there's a sweet spot in a little larger multifamily than just duplexes and single families. So I'd love to hear your perspective.
Right. So let me just preface this by saying, where I am in my investing journey, these types of deals really work for me. If you see someone that further in their journey, sometimes they decide that they want to go after larger multifamily properties because there's an opportunity cost to going after 6 unit, 10 unit, 15 units, right? But let's kind of go back and talk about the BRRRR method. The BRRRR method is a method that was popularized by a Bigger Pockets podcast. I'm sure all your listeners know this host, David Green. Basically, you go and buy a property that's under market value. Distressed, maybe it needs a lot of work. The seller's distressed. You find that property you buy it for a good price. Then you rehab it, you add value to it, you force equity, and then you rent it out at a higher rate than what it was previous would have rented out because of the condition of the property. Then you go back to the bank and you say, hey, my property's gained X amount of equity, X amount of value. What I want to do is I want to refinance it into longer term debt, so I can either, if you're using your own cash, if you're using a hard money or a private lender, which I can get into that part of as well, you refinance that person out. So in some cases, Jeremy, you don't have any money into the deal and you can turn these properties over. You can get infinite returns on these deals. Now, why small multifamily properties? Well, I have 36 units now and I have one single family home. Okay. So if I had just 36 units and I was buying all single family home, I probably wouldn't even have 10 properties now, right? The reason why I find that small multifamily BRRRRs are actually the sweet is because especially if you're starting in your journey, you can get to critical mass, critical scale, economies of scale very quickly just by BRRRRing these properties. It's going to be just as easy to find sort of distressed sellers in this situation that you're going to be able to purchase property for a good number. Just like in single family homes, there's a lot more volume amount of smaller multifamily properties. You can also wholesale them, right? So if you find a property that is maybe a 5 unit and you want to take it and wholesale it and make a little bit of a fee on that because it doesn't fit in your criteria, you can also do that as well. And there's not as much difficulty with maybe wholesaling a 50 unit. You can't really wholesale a 50 unit. It'd be very difficult. So you can wholesale it. You can monetize it like a business. You can BRRRR it like what we were talking about. You can pull out all your equity. if you're early in your process, you could also house hack it, right? So if you're finding these deals, you could also house hack a smaller multifamily property and get a really good return as well. So I don't know if that answered your question, but it kind of told you high level why I think this is a really great niche to get into, because there's still a lot of the professional investors are not really going to be in this niche because, like I said earlier, there's an economies of scale. So you can really build a specialized niche within your local market to buy these properties and be able to BRRRR them or flip them.
Now, are you looking for 5 units and up on these small multifamily? Because then it changes from typically 1 to 4 on the appraisal to refi, right? These banks look at comparable sales versus 5 and up. Typically, it's driven off of your NOI, right? So are you looking 5+ units when you're talking about?
So I basically look for 2 to 20 unit buildings. Okay. So it's a little harder for the bigger, the 18, 20 units to make sense. Usually you're not going to be able to completely BRRRR those, but still there's a sweet spot there, Jeremy, that you can find sellers that have already realized a lot of the equity upside and they're willing to sell it for a number that they think's fair. And that you can increase the value of the property. So I see people not totally BRRRing them, but I see people getting over 25%, 35% cash on cash returns because they go in with bridge debt, they fix it up, and then they refinance. And that's the same exact strategy that we use even on the smaller multifamilies. So I think that you can still sort of use this strategy for those maybe 15 to 20 units, but it's just going to be a little bit harder to find that deal, right? That's just kind of what it is.
Yep. I'm talking with, not lately, but I would say over the last year, spoke with investors about this that are looking to do this, and one hurdle that they are finding is the lender's requirements, either for like seasoning, you have to own it for so long, or the lender, instead of looking just at value, they're looking at loan to cost, like how much money was actually put into it versus, because lenders want skin in the game, right? So how do you get past that? Is it the type of lenders you're dealing with? Are you doing certain things to the properties or setting yourself up to help kind of get over that with the lenders?
Yeah, so that's a really important question. And just so your listeners that don't know, sometimes lenders will require a certain amount of time of you owning a property where it produces cash flow to be able to refinance. For a lot of commercial lenders, they're going to want at least 6 months, someone 12. But I view real estate as a funnel, right? You find deals in a funnel, you got to put a lot of people, talk to a lot of sellers, you get them in a funnel, then they hit your criteria, then you get to the next level. Then you say, okay, I'm going to offer on this. Then you get the next level and you say, okay, maybe I get this under contract. And then you finally get a deal at the bottom of your funnel. It's the same exact thing with lenders. I had to go through like 50 different lenders to find a lender that's going to give me no seasoning requirements and not going to appraise based on the loan to, the loan to cost, the amount that I've already put in the deal. They don't really care. This lender that I use, the local credit union and another local lender that's kind of a mid-sized lender, it's going to say, hey, Clay, as long as it appraises for X amount, we'll give you that loan amount. Now, I would say because of the way that interest rates are currently going, you need to be checking with your banker almost on a weekly basis to say, hey, are you guys still offering LTVs? I used to be able to get 80%. Now, for a lot of these guys, they're wanting to go down to 75%. They might even want to go down to 70% loan to value. And for your listeners that don't know, that means that the appraised value, say it's $100,000, instead of lending up to $80,000, they'll actually lend up to $75,000, even if the deal makes sense higher than that. They don't want that additional risk because the credit markets are going crazy. And I know other people that are, I just talked to a friend of mine, Jeremy, that is a developer, and he develops like 300 unit buildings. And he's having a hard time because interest rates are going up and they're not lending more than 65% loan to cost. So in other words, to answer your question, it's really about finding people, relationships, lenders, contractors, sellers, and just working that funnel constantly. It's a numbers game. It's not easy, but you can totally find local credit unions and small banks, which is what I recommend your listeners do, to find opportunities like this to do the BRRRR on these smaller multifamily properties.
No, that's great advice. Anybody that's listening, if you just rewind about 5 minutes, watching you on video, you with your hands, you had the funnel up. I think we're so used to that concept with properties, right? Like knowing that we're in offers, we're going to have to put 10, 20, 30, 40 offers for that one property, right? But that also comes down to the same sense, our lenders. I mean, the lenders are such a big part of our business, right? We need to find the right lenders with the right debt terms to fit our business model. And I think you said that perfectly. And, all the listeners definitely take heed of that advice. That's perfect. So,
right. And just add on to that really quickly. I don't mean to interrupt here, but I always looked out and said, if someone else can do this, right? If someone else can find better lending terms, if someone else can find good private money, because I raise private money from investors all the time, give them really great returns and I use it and recycle it. And we have private lenders that have been working with us the whole time. If someone else can do it, so can you, right? And so if you just take the mentality of doing the actual boring work to reach out to lenders, to have conversations, and if you're an early investor, a new investor, you might have to take a kick in the face with lower amortization, higher interest rates. But as you gain confidence and build your relationship with lenders, you have to constantly be talking to new lenders. But as you build confidence, you can start to say, hey, what's the product that you're offering, right? What are you doing? What can you do for me? And a lot of times I can tell you on the first time that I ever did this, I was nervous. I had the worst loan terms ever. I had a 20-year AM, 1.5 over prime with a 5-year reset in 2 points on a refi.
wow.
It was atrocious, but I said, listen, I just got to get one deal done. I got to get one deal done so that I can start to build credibility with myself internally for my identity, but also with lenders so that I can go to another lender next time and say, hey, I did this deal. Here are the specs. What type of products that you have that can really work well with me? I also want to build a long-term relationship with you. And here's one last quick tip. The best thing that you can say to a small community lender to start off the conversation is, hey, I understand that really important things. You can take this exact script. I've used this many times. I understand that it's very important for you to have deposits on your ledger. I am willing to move my banking to your bank if we can find a way to make a good deal happen. That to them is like, this person knows me, they understand me, they're speaking my language. If you start your first conversations off by talking about depositing your money into their bank and building a long-term relationship, then you're going to be way further ahead than other people that are just saying, hey, do you have this? Do you have this? Do you have this? That's very important when building a relationship with any bank, but it's particularly pertinent when building a relationship with smaller banks. Sometimes those lenders actually get commissions off of deposits too. So I know that was a lot, Jeremy, but I hope that that was helpful for your listeners.
No, it was. That was tremendous. I appreciate you adding that extra tidbit in there. So finding these off-market deals, you mentioned, you started off, you guys wholesaled 75 properties when you joined that company. Yep. Finding off-market deals, maybe a couple of years ago, a lot easier than today. How are you guys going about doing that in such a competitive market?
Yep. So every which way I can do it, I closed 9 units with wholesalers in the past month. I know how to speak that language. Again, it's always when you talk with someone, wholesalers in particular, wholesalers are motivated for the highest commission, right? But if you can paint a picture that maybe not selling to you is going to be the highest commission, but it's going to be the biggest sure bet, especially when you're dealing with multifamily properties, it's hard to schedule you to get in. There's a lot of different things that makes wholesaling multifamily properties a little bit more difficult than just a single family home. But I've communicated to wholesalers, I know how to speak their language. Hey, what's a win for you? Really focusing on them, I check in with my wholesalers every single week. It's just like checking with brokers for larger multifamily. Every single week, I send them a message. I give them a call. Hey, what's going on? What's new? It could be a 3-minute call or 2-minute call. Just say, hey, what's going on? I'm still buying in these areas. How's your business going? Is there any way that I can help you? Do you need any lender recommendations? Do you need any X, Y, and Z recommendations? So wholesalers are one of the ways I do it. I also use direct mail. I target a direct mail list, a very specific list. People that have owned the property for a long period of time, they got to have a lot of equity. And I just relentlessly shoot out direct mail. I use agents as well. I always talk to agents. Hey, do you have any deals that would be of interest when selling? One of the 6 units that I bought, actually, I bought off Craigslist. I sometimes will go on Craigslist if I'm not having a lot of leads. And I'll just call for rent signs. And I'm actually getting a VA to start to do that for me. Even with larger multifamilies, these mom and pops still post their rental listings on Craigslist. Mm-hmm. So you can call the 4 rental listings on Craigslist and say, hey, I know you're probably not, so you're looking to rent this out. Would you consider an offer on it? And, also just being in the community, constantly talking with people. One of the ways that I bought my second deal ever was I cold called a woman about one of her buildings. It was like a 15-unit building and she didn't want to sell. And I said, hey, okay, that's fine that you don't want to sell. Would you know anyone else that would be interested in selling? And she said, actually, my son was thinking about selling his 3-unit. His 3-unit is right next to another one of my 3 units. So I said, okay, great. I set up a call. 2 months later, we closed.
Nice.
So it's really just about constantly talking. Again, focus on the funnel. How many people can you talk about? Hey, I buy small multifamily properties in X area. Constantly talking about, I'm looking for properties. I'm looking for lenders. Your job is to create a business around getting deals and finding money opportunities to get deals. Sole and only focus should be filling up your funnel with lenders and filling up your funnel with sellers.
No, that sounds solid avenues for finding deals. That's great. So the construction piece on value add properties, right, I think is such an important piece that sometimes doesn't get talked about a whole lot. Now, I would say, is your group like differentiating yourself from other investors if, operating within the same space as yourself, but maybe on the construction side or implementing certain tactics or certain processes to make it more efficient with your contractors? Are you providing any unique amenities to your tenants? Just how are you making you guys look different, versus competition in the market?
That is such a good question. And I commend you for asking that, because a lot of times people think that real estate is buying the deal. It's like 95% of it. And it's actually not. 95% of it is after you buy the deal. Mm-hmm. So we're talking about this whole conversation is about buying it. The rehab is actually the most important thing. Contractors are always hard. It's very difficult to set up systems. Sometimes they don't want to play in your system. Like we have an Asana backend. Asana is a project management software that we use for our team to coordinate purchasing SKUs, delivering SKUs, weekly accountability. Basically, one of the things that we do is at the beginning of every week, we post the things that we need to get done that week for our contractors. We have some contractors that are Spanish speaking. I speak Spanish fluently, so I can speak with them. I coordinate with them. We have some contractors that are Americans and some that are Chinese. I don't speak any Chinese, but we write out a weekly to-do list, post it every single room. We just post it on the wall. If our GC has any questions about it, they can just let us know. But we're doing the project managing of the GCs. But construction is constantly in flux. It's probably the biggest hurdle that we have, the biggest challenge that we have to face on a daily basis, because, inspiring your contractors to finish things on time, even if you do give them $1 million of construction in 3 months, they don't care. Like these guys, they run by their own rules. So it's really about finding the balance between being stringent with them and also giving them a little bit of lax, because you don't want to lose them. But we use Asana as a project management to keep them essentially organized. And then we post on a weekly basis to say, hey, this is what we need to complete by the end of the week.
Mm-hmm. No, that's great. So from an amenity side, are you typically buying a lot of like older buildings, 1920s range? Okay.
So it really depends on the amenities that, the neighborhood, because we buy in a lot of different neighborhoods, but our amenities, we have a 6-unit. There's maybe we'll like create parking spots, paint more parking spots and add a main washer and dryer. But a lot of these buildings are not new build Class A luxury or post 1980 builds. The amenities that we're offering them is more an upgraded space, quartz countertops, stainless steel appliances, laundry, in-suite, air conditioning, which is not super common in the northeastern cities. So those are sort of the amenities that we're offering. Outside of that, not really that much.
Yeah, no, but the listeners could be anywhere in the country. It really depends on your market, right? And even in your subsection of your market, your neighborhoods that you're in, being cognizant of that, because one of the worst things you could do is over improve a building, spend a ton of money. You don't get the value out of it because the rent's not there, even if you do X, Y, and Z, because no one else is doing it. Right. So you have to be cognizant of it is really important. So no, that makes a lot of sense. I deal in Pennsylvania as well, in the Lehigh Valley, and it's very similar, some of the properties in the markets that I'm in and the amenities that, can be provided. So that makes sense. So
I think you raised an excellent point about, making sure that when you renovate a property, the look of the property is better or equal to your competition. Because you can get the highest rent, even if you're in a C area, you can have an A-class property in a C area and you can get B renters. That is something that we always strive to do. So we strive to bring a good product to the market.
That's great. So Clay, in closing, as we round out the show, is there a way for our listeners to get in touch with you, following on social media? What's the best way for them to do that?
Yeah, I'm on social media. I talk about my BRRRR journey. I talk about BRRRing, how to be more efficient with BRRRing, how to implement sales tactics to get better deals. At Clay Hepler on all platforms. You can just look me up. Mm-hmm. And you'll find me on Instagram. I'm very active on Instagram. I have a TikTok, not super active on TikTok, but getting more active, and LinkedIn and Facebook. So seriously, anyone has any questions, I don't have any courses to sell anyone. I just love this business. It allowed me to quit my job in under 2 years. So I'm always open and willing to help people with how to pitch private lenders, how to build a business, how to wholesale, all that stuff. I'd be delighted to help any of your listeners.
That's tremendous. Thanks, Clay. Thanks so much for your time. I really appreciate it. So this is Jeremy Moyer with Real Estate Investor MBA. Please sure to tune in next time. We'll see you guys then. Thank you.